I mean, it is honestly fascinating how a business can literally build cooling systems for a commercial lunar lander, print absolute record revenues, and somehow still watch their bottom line shrink. Welcome to Earnings Unscripted, folks. Today we are unpacking Graham Corporation, ticker GHM. It is June 8th, 2026, and we are looking at their fourth quarter. Miro, what a totally wild divergence between the top and bottom lines here.
It really is. And, the market hated that divergence immediately. There was this pretty brutal pre-market gap down. The stock dropped over 9% right out of the gate. They did stabilize during the earnings call, clawing back to finish the day at 97.19. But you just do not erase a drop like that without leaving some real anxiety behind.
Right, because on the surface, it absolutely looks like a red flag. I mean, revenue hit a record $67.1 million. That is up a solid 18% from 56.7 last quarter, which sounds great, but then operating income just slipped down to 2.7 million from 3.1.
Exactly, and your net income took a 31% hit, down to 2.0 million. EPS followed right along, dropping from 25 cents to 18 cents. So you get this classic profit paradox. They are selling much more, but keeping a lot less of it.
And we are not talking about cheap widgets here. They are building critical, heavy infrastructure, stuff for U.S. Navy submarines and, like I mentioned, these wild cryogenic pumps for the space race.
Which is a detail I actually love. They went ahead and built a dedicated liquid hydrogen test facility down in Florida, just so their aerospace clients don't accidentally blow up their own labs trying to test the plumbing.
Okay, a highly underrated selling point. Before I forget, though, a quick legal sanity check. This podcast is strictly for entertainment and sharing our own opinions. It is not financial advice, so please do not go buying space infrastructure based on our banter. But Miro, this is where I actually need your brain, because those massive government and space orders explain exactly why the margins look so ugly right now.
Yeah, it's basically an optical illusion in their accounting. When they receive a massive shipment of raw heavy metal to start a defense build, they log that as revenue right away. But since they haven't applied any actual human labor to it yet, it carries zero or incredibly low margin.
Right, so high material flow up front equals terrible margin percentages today. That completely tracks. But wait, that still doesn't explain why their cash flow from operations actually went negative this quarter. There's a whole different weird thing happening there with a new acquisition. All right, let's actually get into the details on that.
Yeah, it comes down entirely to FlackTek. They closed that acquisition back in January, but the cash flow hit we are seeing right now is, it's essentially an accounting sleight of hand.
Okay, sleight of hand sounds vaguely illegal, so clarify what you mean. The money still left the building, right?
Right. No, not illegal, just clever deal structuring. Let me actually quote the CFO on this because he phrased it very deliberately. He said the quarter's cash flow was, quote, negatively impacted by approximately $4 million of transaction bonuses assumed in the FlackTek acquisition, but paid by the company, and was a reduction to the cash purchase price.
Wait, so the previous owners of FlackTek had promised bonuses to their employees and Graham just paid them out of pocket?
Exactly. Graham essentially said, look, we will cover the retention bonuses you owe your team, but we are going to knock that exact $4 million off the sticker price of the whole company.
I see it. So because it is technically a payroll event, it shows up as an operating expense on the cash flow statement instead of, a standard investing expense for buying the business.
Yes, precisely. It tanked their Q4 operating cash flow into the red, negative 0.15 million roughly, which obviously makes the operations look terrible on a simple stock screener. But from a sheer capital standpoint, it's exactly the same amount of cash leaving. It just took a detour through the income statement.
That is entirely why you have to read the footnotes. Okay, so the core business is not suddenly bleeding cash. But actually, speaking of capital moving around, we really need to talk about that $50 million private equity style injection. The timing is it feels highly unusual.
Unusual is a very polite word for it. Literally days after the fiscal year ends in April, they just announced a $50 million placement with accounts advised by Rowe Price. Bam! $50 million in the bank, and they immediately took $13 million of that to completely wipe out the revolving debt they just took on for FlackTek.
Which leaves them sitting on roughly $37 million in pure dry powder. Are they really going hunting again? I mean, they literally just swallowed FlackTek.
That is the only logical conclusion. You don't take on equity dilution just to let the cash sit in a checking account. They're clearly reloading the M&A war chest. And honestly, it tracks perfectly with this broader pivot the CEO kept pushing about, going on the offensive.
Wait, you mean the aftermarket pivot? Because traditionally in heavy industrial, the service model is, well, you just wait for something to break and then charge a fortune to fix it.
Exactly. It's almost entirely reactive. But Graham has this, it's something like $1 billion global installed base. They know exactly where every single legacy condenser and old vacuum system is sitting. So instead of waiting for a distressed phone call, they're using that data proactively. They walk into a chemical refinery and essentially say, hey, we have this new next-gen nozzle. It cuts your footprint, lowers your energy consumption. Let's modernize your facility before your current setup fails.
See, that is actually brilliant. You're taking totally unpredictable emergency repairs and converting them into a predictable, proactive sales pipeline.
Right, and unlocking higher margins along the way. But the catch is execution, because that requires a completely different sales culture. Plus, let's not forget, while they are out pitching this slick modernization to the Navy and energy companies, internally they are currently tearing out a dinosaur legacy AS400 database to deploy a modern ERP system.
Oh, geez. An ERP migration. The absolute graveyard of corporate productivity.
Right? It is a huge risk. The Batavia plant is approaching go live, and if there are supply chain or invoicing hiccups there next quarter, things could get messy fast.
So they have this massive new cash pile, an aggressive appetite for M&A, an entirely new sales strategy, and they are ripping out their internal tech stack at the exact same time. It feels like they are moving so incredibly fast for a company making 70-year-old metal parts. Let's take a step back and look at what all this actually means for their forward guidance, because next year is going to be wildly different.
Yes, wildly different, though management actually wants you to think it is just business as usual. I loved this one quote from the CEO on the call. He literally said they are executing, quote, 250-yard drives down the middle of the fairway, and that they are not overextending.
Oh, come on. They just bought a whole company, raised $50 million practically overnight, and they're ripping out their entire database infrastructure. That is his definition of the middle of the fairway?
Right. It is a very aggressive fairway. But look, the fiscal 2027 guidance really backs up his confidence. They are projecting full-year revenues between $285 and $295 million. So that's roughly 18% growth at the midpoint, and they see adjusted EBITDA climbing up to $40 million.
Okay, well, I guess that massive $533 million backlog is doing a lot of the heavy lifting there.
It is doing almost all the heavy lifting.
But wait, what about the legacy business? Because the traditional petrochem market is kind of freezing up right now, isn't it? Just with all the geopolitical caution and energy prices swinging around.
Yeah, capital expenditures in refining are absolutely getting pushed out. But they are completely offsetting that weakness with new nuclear, small modular reactors specifically.
Oh, right, because of the data centers.
Exactly. The sheer power demand from the AI boom is forcing this massive pivot back to nuclear energy, and Graham builds the critical heat exchangers for those exact setups. So if petrochem stalls, nuclear and space essentially pick up the slack.
It really feels like they went from being this quiet, traditional Rust Belt manufacturer to suddenly sitting at the exact crossroads of global defense, AI energy grids, and the space race. It is
it's just a completely different animal now.
It is. My only real caution for next quarter is exactly what you just said, digesting it all. We are going to see a full 3 months of FlackTek amortization, dragging down Q1 margins instead of just 2. So headline profits might look a bit sluggish again. They just need to keep the new IT system from crashing while they build out the Lunar pumps.
So the ultimate takeaway here is keep your eyes on the highly unsexy software migration, not just the rockets.
Always trust the IT department to keep the aerospace engineers grounded.
That's perfectly said. All right, that covers the big moving parts for Graham Corporation this quarter. So, if you enjoy exploring these market stories with us, feel free to follow the show so new episodes just appear in your feed. And just as a quick aside, we do use AI to help structure our research scripts, keeping things completely transparent with you. We always love a good puzzle, so if there is a specific ticker you want us to look at next, shoot an email to earningsunscripted@dytamadness.ca or catch the X link in the show notes.
Until the next earnings drop.